Hi, everybody. Good afternoon. Thank you all for joining us. We'll just take 1 second to get all set up. Mauro, you're able to see my screen?
Yes.
Perfect. Good afternoon, everybody. My name is Kamal Hakim, and I work as a project manager at GenUSA. Thank you all for joining us today for our special webinar where we're going to discuss tariffs and business strategies, but more importantly, how you can protect your company and grow your company business in the US. Brief overview of the agenda. I will get started by speaking about the overview of current tariffs in the US. And then my colleague Mauro, the partner at GenUSA, will actually speak about what are the different strategies and tools and actions that you can use for your own businesses in order to reduce any economic impact of these tariffs. And then we will focus more on what are the different steps needed to open a company in the US. And at any point, if you have any questions, feel free to leave them in the Q&A section. We will be monitoring them throughout, and we'll actually have a session towards the end where we'll go through and answer any questions live on the webinar. First and foremost, before we get started, I would like to share with you a little bit more about our company, about GenUSA and what we specialize in. We are, first and foremost, an American company. We have our headquarters based in Florida with offices across the US and our European office based in Milan, Italy. We help European companies step by step in the process of expanding their operations into the United States. It means we don't just provide advice and then step back. We work side by side with you and we tailor a custom plan to make sure that you operate successfully in the US. We've been operating now for more than 15 years, and we have dozens of clients, I think around 60 customers that are active right now using our platform and our knowledge. For most of those companies, they're all European, but for most of them, it's a huge opportunity to either enter into the US market or expand into the US market. And our job is to help translate the nuances between doing business in the US versus the home country. Why work with us? Well, I like to break it down into three main reasons. The first one is the speed of access. Setting up in the US. So if you think about all the different steps that you need to do to get an office, to get staff, to do anything that you know requires any kind of stability, it takes years and years and years. However, with us, the trial and error is already done. We have office spaces throughout the US with a team that can work on your behalf. So it's almost as if it's a plug and play. Second, our focus is directly on the US market. Our job, our team of people, is to understand the US arena in detail so that you can step in without taking on any unnecessary risk or trial and error. And third, I touched on a little bit before, is that we're a one-stop source. It means you won't have five different consultants for strategy or legal advice or HR, logistics, so on and so forth. We integrate all those into one platform. And we do have a wide network of professionals that we trust and who we've used in the past in case there are some parts in which they could be stronger in than us. And so, for example, now, because of all the tariffs with Trump, we deal with this on all 60 of our companies. We've delved into different sectors and different manufacturing and so on and so forth to know how to overcome the tariffs. Working with us, you'll provide a whole breadth of knowledge, which we would like to give you just a small overview now. And then I'm going to turn it over to Mauro after to explain how we can support in these endeavors. Our locations are New York, Miami, and Delaware. And our European office is in Milan. And our email is located here if you'd like to notate that. We'll also present this to you at the end of the presentation in case you would like to get in touch with us at any point, either during the webinar or after. We'd be happy to discuss. GenUSA is part of the wider Gen network. So as I mentioned, our headquarter for worldwide is here in Europe. However, GenUSA is the bread and butter for the company. It's the one that's been operating for the longest time, over 15 years. Recently, we've set up different sister corporations, we like to call them, in the UAE and also in Saudi Arabia, as well as a presence in Brazil, India, and the next opening will soon be Hong Kong. I showed this to you not because of any particular reason, other than to say that our business model, our operating platform, is to have a presence on the ground in each one of these countries, so that whenever we do advise our clients, if they choose to expand to different countries, we have a team of experts there to be able to support them in the same way. Today, we're focused on the US, but you can just as easily take what I'm saying now and replicate it on Emirates, for example. If your business is looking to expand in the UAE, the same services and details that we're sharing with you can be replicated there with our team that's located on the ground in Dubai. Our list of services. So it's a lot. You can see a lot on here. However, it's important. So each line represents a real challenge that any one of our companies have faced when they expand into the US. And this is a simple summary on the different tasks that we've done for our customers and that we've experienced doing also for you. Whenever we start, we like to create a market analysis, feasibility studies. It's about knowing your product. Each customer we work with is different. Of course, we do have some customers that operate in similar sectors. However, each company is unique. And so understanding what you're trying to get into is important. Next, we can also handle the search for different loans or incentives, both from Europe that provides for their companies for internationalization, but also on the US side. One project comes to mind. Last year, we had a customer who was relocating their entire warehouse operations to the US from a foreign country. And we helped them try to negotiate the best deal with the local city, county, and state taxes and different government regulations. So there are many incentives and opportunities if you know where to look. So that's something that we know very well. And then when talking about different certifications and compliance, the US is strict, as I'm sure Europe is as well. If you're in the food market, for example, or in equipment or pharmaceuticals, having the right certification, it's not just an option, but it's crucial. And knowing what transfers from Europe to the United States is also something important for you to have. In terms of legal and tax support, we do our best to share with you our knowledge and also connect you to our wider network of professionals who can help file those for you. Now, some of our special services would be things like visas, recruiting. If you've got a team of people in Europe that you would like to send somebody over to the US to help with their US operations, we have a visa department that can assist and actually complete the entire application from beginning to end. Alternatively, if you're looking to hire somebody in the US, we do have a recruiting department which scouts people for you in the US and handles everything from searching for the right person all the way to onboarding them into your system, and also continuing through with HR and payroll. So if you select us for recruiting, we help you find the person, run through the interviews, integrate them into your company, and also assist with the payroll throughout the lifespan of having them in your company. As part of our turnkey package, we offer logistics support as well. So if, let's say you are a company that is in need of a team on the ground to handle orders and shipments, our team will work directly with you in order to facilitate the logistics that go on behind the scenes, so that you don't have to necessarily hire a team member or different staff to do different tasks. We loan you, in a sense, our team members for certain packages of hours in order to handle these services. Mauro is going to get into the specifics in just a few moments. That is a general overview. I left this on the screen for a while so you can take a look, but if you have any questions or you would like to talk about anything in particular, feel free to ask any questions in the Q&A or send us an email. Real quick, these are some of our current customers. I mentioned we have about 60 customers. These are the ones that we were able to pull up just for they could fit on the slide. You might recognize some of these companies that have been around for hundreds of years as well, like Brazzale, for example, is the oldest dairy cheese manufacturer operational in Italy. We've got companies from all different sectors. Now, let's move on to an overview of the US tariffs. The US, at this moment, September 30th, 2025, currently applies blanket tariffs by country. This was a strategy by the US president in order to negotiate good trade deals on a country by country basis. As it stands now, the EU is set at a blanket tariff of 15%. I'll explain the different variations and I'll take questions as well so that we know exactly which products fall into what. But if the product doesn't fall into a certain category, the blanket is 15% for the products, 35% for products coming from Canada, a proposed 30% for products coming from Mexico, which at the moment is now suspended. It's being waited on. They're trying to negotiate some sort of deal behind the scenes. China is at 55%, and both Brazil and India have a 50% tariff on any of their products coming into the United States. On top of these blanket tariffs, the US applies special tariffs for certain sectors that it considers strategic, like auto sector, steel, aluminum. And at the same time, there are other sectors that are exempt because the US relies on them heavily for national security purposes, like aerospace, some pharmaceuticals. There has been talk of this new 100% tariff for pharmaceuticals that Trump signed into law a few days ago, but it excludes any pharmaceutical companies that currently have plans to build in the United States. So in the next few slides, I'll go over the different categories, but just to give you an overview that right now, most of the people watching right now are representing European companies. European companies are not alone. It's actually one of the most favored economies in the world when it comes to tariffs that the US imposes on trading partners. Something else to note actually is that with all these tariffs, there is a lot of legal uncertainty because of the way the president issued the tariffs. Just in August, about a month ago, the Federal Circuit ruled that many of these tariffs that were issued under the IEEPA stance that the Trump president signed into law could be illegal. It could be illegal because saying that the president doesn't have the authority to do this kind of thing. So right now there is some legal back and forth behind it. The Supreme Court is going to review all of this in November, but as of now, there is a hold on these tariffs, so they're not going away anytime soon until the Supreme Court reviews in November. So we might see major changes within a few months. So even though a lot of companies in Europe, many of our clients included, are happy that there is certainty, there's the 15%, at least there's some kind of certainty, things can change, as always, hopefully for the better. Now, for European companies, the picture looks like this. The average tariff rate now is about 13.1% if you include all the different imports into the US. It's up about 3 percentage points since June. So in June, it was 10.2%. And now at the end of September, it's 13.1%. It reflects the impact of both the blanket tariff and the sector-specific tariffs. Most goods do fall under this 15% tariff, which functions as an all-inclusive ceiling. However, certain sectors like automobiles and components are also at 15%, which actually was reduced from 27.5%, which was the tariff before all the changes, retroactive to August 1st. Steel and aluminum, however, still face a high tariff of 50%, 50. This is one of the heaviest burdens and creates a strong pressure on EU producers to either absorb the costs or consider a joint quota system currently under discussion with the government. Wine and spirits, however, are set at 15%, which falls under the general umbrella, while generic pharmaceuticals and their chemical precursors are exempt at 0%. It was designed to protect the US healthcare affordability. However, there is the one big elephant in the room regarding the pharmaceutical tariffs I mentioned previously. If a company is currently constructing a manufacturing plant for pharmaceuticals or is in the process of getting approvals to create a plant, then they are exempt from the 100% tariff that will be added. The EU, in particular, is pushing for exemptions on wine in future rounds of discussions, and for steel, they're pushing for a quota and anti-dumping in the future. China, on the other hand, faces one of the highest tariff rates overall, as compared to many of the other countries. The universal tariff rate is set at 55% on nearly every good. Then there are certain sector-specific tariffs, such as electric cars, which currently are at 155%, solar panels, 105%, steel and aluminum, about 80%. The reason why I'm going over in detail on all the different countries besides just EU is to give you a sense, because in this world that we live in, this interconnected world, I assume with manufacturing, you source materials from many different countries depending on your sector. So having the right plan in place, knowing that, okay, if a percentage of my product comes from China, then it gets exported to the US, I might fall into these tariffs. So just to give you a basic overview. There are a few exemptions, however, with these China tariffs, including generic pharmaceuticals, aerospace, and certain industrial machinery. But the average effective rate is still around 40% on Chinese imports. You can compare that to about 13% from the EU, and you see it's much higher coming from China. Another thing to note is that this is part of a 90-day extension that was signed in by Trump in August to keep the rates at 55%, and it blocked an escalation up to 145%. So if you recall, over the summer, every day there was something where the tariff kept getting higher and higher and higher. In August, they decided to resume talks. The US decided to resume talks with China to come up with an overall trade agreement. So for 90 days, the tariff rate is set at 55% with these exemptions. Focusing now on two of the biggest trading partners of the US, Canada and Mexico, which both fall under the free trade agreement that was signed during Trump's first presidency 7, 8 years ago. It was called USMCA. It's still in effect. Many products actually fall into this. About 85% of all transactions, 85% of all imports from Canada and Mexico to the US are currently exempt, and these tariffs do not cover them. However, it's important to note that there are tariff quotas, so a certain percentage of a good must be made in the US or in North America, in one of these countries, in order to be considered exempt under the USMCA, which itself was a rewrite of NAFTA, which was the previous free trade agreement signed in the 90s. To qualify, these products must meet the strict rules of origin. So typically between 60 to 75% of a given product, depending on the sector, must come from the US, Mexico, or Canada. Now, producers will need to provide a certain certification of origin to prove that the products were actually made in these countries. It doesn't have to be a big official form anymore. It can just be a statement on an invoice, but it must be accurate. Companies must comply with technical standards and even wage levels in some sectors. So, as is well known fact, in some countries the labor is much less expensive. Think about Mexico versus the US. So there are limitations on that in order to make the US a little bit more competitive in that realm. Another thing to note is that while the requirements on proof of origin have lessened and made it a little bit easier, where you just have to note it on the invoice, customs authorities in all three of these countries can also request further proof at any time. So it's important that we have everything set up and ready to go. In more detail, Canada, 35% blanket tariff in force. Mexico, 30% blanket tariff, which is suspended. This covers anything that is not covered under the USMCA agreement. So if your goods do qualify for the USMCA, tariffs are zero on almost all categories. This includes aerospace, pharmaceuticals, and specialized machinery. So basically, the reason why I want to show you this slide and explain the rules of origin and so on and so forth is because the difference of a company having to pay 0% tariff, 35%, or 50% in some cases can come down to paperwork and sourcing decisions. Even if most of you all are European companies, if you do source certain products from different countries and document it in the proper way, you might be able to avoid the worst effects of these tariffs. This is why companies need to carefully structure the different supply chains around these USMCA rules. Now, finally, my last slide for you today is a focus on Brazil and India, which are both subject to blanket tariffs of 50%, except for some exemptions. For Brazil, this was really a sudden jump. It used to be 10% before early August, jumped to 50%. It was tied to a US national emergency declaration that Trump signed off on. For India, however, the same 50% rate was introduced in August as well, but it was connected to secondary sanctions related to Russian oil, political reasons. Certain categories in both countries are exempt. Think about energy, aerospace, minerals, and some specialized machinery and pharmaceuticals, but the majority of goods do fall under the 50% rate. Unfortunately, there's not a free trade agreement as there is in North America with Mexico and Canada at the moment. So it means if you're sourcing products from Brazil or India, please check carefully if your product code falls into one of the exempt lists. Otherwise, the 50% blanket applies. And with that, I wrap up my section about tariffs. Mauro will take it from here, and he will give some really great advice on how you can strategize to overcome these problems. And also, if you decide you would like to grow and expand into the US, what are these different steps in order to do so? So thank you all for your time. I'm still here. Please ask any questions in the chat, and we'd be happy to help you out.
Thank you, Kamal. Thank you for your presentation. I think that it's a good overview regarding the tariffs that are in force now, and of course we cannot avoid that could be changed. It could be a change in the near future, for example, for pharmaceutical branded product, also for cabinets and for trucks, but they should not impact with the European companies because there is already an agreement, and with the other countries that have already an agreement with the US. So there are some small, we can do something, company can do something to mitigate the impact of strategies, of tariffs. First of all, we can understand that a lot of companies have to renegotiate the contracts because I'm sure that many contracts are done well before the announcement of tariffs, and for products that are delivered in the future during the year. So, of course, the manufacturer and importers doesn't know who is going to pay for that tariffs. So it is important to renegotiate the contracts, and most of the time, also the importers are in troubles because they are obliged to mark up to mark up a lot of the products that they sell in the US. So and sometimes, of course, the importers are afraid to lose the customers. So there is another rule in the US that it is the first sale rule. It allows, in case of chain of sales, to calculate the import duties on the price of the first sales from the manufacturer to intermediary instead of the final price paid by the importer. This rule has been applied, has been done a lot in the cosmetics or in fashion industry, where a lot of companies, they buy products from a small manufacturer for a small price, and they sell without touching it in the US. So it is possible that the tariff will impact only in the first trade from manufacturer to the intermediary. So also another strategy is to rebrand the products. So to raise the positioning and to make them irresistible. It means that in this way, it will be very hard to for the importers to change manufacturer, to change, to switch from to another manufacturer in this way, because there is only the European manufacturer could be the only manufacturer that could be chosen. And of course, when the positioning is very high, there is a low price sensitivity to the high-level product. Also, there is another strategy, there is another activity that can be done to mitigate the impact of the tariffs, and is the breakdown of transfer price. Usually the tariffs impact only in the raw materials and the processing, on the labor. Most of time is possible. We suggest most of time to separate, to invoice to make a different invoices for pre-sales and post-sales services, royalties, marketing, or whatever. So, and of course, the impact, the tariff will not impact this part of the value of the product. Also, sometimes it's possible to do some tariff engineering. So it means that sometimes we suggest to redesign or slightly modify the products and packaging to fall into less cost tariff products. So, of course, the best way to avoid the tariffs is to make to do the integration of the product in with the US components, made components, or to assembly directly in the US. Sometime we suggest the customer to establish a US legal entity in the US, and we can see later what does it mean. And also, it's possible to store in the US in some free zone where in this way, when the company ship the product in the US in this free zone, the tariffs are not paid immediately, but can be paid only when the goods is sold. And last but not least, it's possible to request a duty exemptions to the tariffs if the product is not is very important for the U.S. economy, or absolutely doesn't exist in the U.S. territory. So, but of course, the U.S. market can be. There are a lot of index that can be has to be evaluated beyond tariffs in the US. First of all, we have to say that the value of the dollar, the dollar currency, will be weak in the next 2 years. The forecast says that could be around 1.5 euros or 1.7 euros in the next 2 years. Also, the US GDP, the growth will be an average of 2%. The average of the energy, usually in the US, is very low compared to the European in Europe, but we can say that there is a widespread between Texas and Canada and all the other states. The U.S. unemployment is 4.3%, and the market is very fluid, and the cost of the labor will be increased. Will increase more or less 3% per year. We can say that. Specialized and workforce in the US is very it's very hard to find people and workforce in the US. So we were aware that to recruit in the US is very hard. Also, the taxation. The taxation in the US, it is comparable, or at least there sometimes is better than in Europe. There is a federal taxation flat of 25% in all over the US, and also there is a state tax that varies between 0 and 11%, and then sometimes if you have a plant in the US, there is the property tax or the inventory tax that can impact on the revenue, on the margins of the business. And please consider there is no VAT in the US. There is only a sales tax that can be charged not only to the final user or the consumer people. Also, what is important to say that is in the US is it is easy to do business according to the World Bank. It is at the sixth it is ranked the sixth in 2020 from the World Bank, and Germany is 22 the rank in World Bank, and the UK is 8. Cost of money. We have seen that the Federal Reserve has lowered the cost of money. Now it is between 4 and 4.25% in the US. In Europe is 2.15%. Also, what we can say that for sure this economy, the US economy, will be the first economy in 2030, but for sure we can say that into 2070 will be the third in the world, still the third in the world after India and China. So we say that because of course the companies go to the US to be there for a lot of the screen is frozen. Okay, sorry. That's for they do in the US for a lot of for many years. So there are a lot of attractions, policies to attract the investment in the US. So there is ERA, the Buy America, Buy America, Build America, Buy America, one big beautiful bill. There are a lot of incentives to the company that go to produce in the US. Sorry, they told me that the screen is frozen. I don't know why. I don't know if it is fine now. Let me check.
Yeah, Mauro, can you try stopping the screen share and just reactivating
okay, I will do that.
work.
Okay, just a moment. I'll do immediately. I don't know.
Perfect.
How is now.
Yes. Good. And it's at full screen. Yes.
Okay. What does it mean open a company in the US? Because perhaps no. Okay. This is the correct slide. Why the presence of a legal entity can help to reduce the impact of tariffs? First of all, it is possible there is an easier application of the first sale rule. So because you sell to the director of your own company in the US, so it means that you are not forced to disclose the price to the final customer in the US. And also, there is an internal management or intercom, so you can decide who is going to pay the transport, and it is possible to decide who is going to pay the tariffs. So if and charge them to the company that has larger margins, where so in that case you can save some money on taxes. Also, I'll say, okay, internal, you can ad hoc manage the transfer pricing between the two companies, European company, the headquarter, and subsidiary, of course. And internally, you can decide how to the breakdown of the transfer pricing, so you can have different invoices for labor and raw materials and other fees that as intellectual properties, branding, design services, and so on, that are not impacted by the tariffs. But above all, to have a presence in the US means that you are very close to your American customer. That it's very appreciated to the American customer because the agreement will be done in the legal environment, American legal environment. You can invoice in dollars, cash in checks, and provide an appropriate customer service to the American customer. What does it mean? What does it mean to have open a company, a corporation LLC? First of all, you can have your headquarters everywhere in the US. And of course, the criteria were to have the legal company, legal headquarters has to be change depending on the criteria. It could be commercial, logistical, and or for example, you can decide to be in the specific industry in the US. A specific industry where it is in the US. As I told you before, the taxation is 25% federal, or there is a state tax between 0 and 11%. But above all, remember that there is the nexus. The nexus rule. It means that the state tax are paid in the percentage of the state tax are paid depending on where the company does the value add. So also the Delaware. The Delaware is a suitable state for companies that they are seeking financing or they are aiming to be listed in the stock exchange. It means that, but in another case, there is no meaning for the companies to be. In a case, there is no meaning for companies to be in Delaware, and also the legal. There are very low legal tax obligation. Of course, you have to keep the accounting records, to file the income tax return, and do a renewal of report and register agent, of course. And of course, if it is needed to cash the and transfer the sales tax. But that's it. It is very easy to set up a corporation in the US. What do we do for this company that are already in the US or they aim to have a subsidiary in the US? For sure, we can host their company in our office. So they don't need this customer. They don't need to have an office, their office in the US, because they are our guests. And of course, we can provide them staff that are able to manage all the accounting, all the customer service, to manage the HR, the payroll, the health insurance, 401k for all the staff that are based in the US. In this way, the company can focus on the business development and they don't need local staff for the daily operation. So, as you see, this is an example how we work. The subsidiary that you can see in the center of the slide is based usually in our offices, and our employee can deliver service as customer service that talks speaks usually with the vendors, warehouses, local customer, and local employees, sales employee or engineers. They do administration, accounting. Of course, we provide the payroll, all the HR management, and of course we provide all legal and tax management. Of course, this our people in the US talk every day with the headquarters to report whatever is needed in to the headquarters in the US, headquarters in Europe. So, and of course, we work in the time zone in the US, mainly in the Atlantic time zone, Eastern time. So, this is the main activities of the customer service. So, we speak with the US sales teams of the customer. We speak all the time with the customer to understand, to manage the whole of the processing, and to receive their purchase order most of times. We work with the production team. We talk with the production team in Europe or in the US to tell them if there is a case of out of stock, or to keep information, to give them information about the stock on track. And of course, we talk with the warehouse to manage the processment, the shipment from Europe to the US, and from the US warehouse to the final customer. Regarding the accounting, we do manage all the activities. We manage bill payments. We do bank reconciliation. We do reporting every month to how is going the subsidiary, and whatever is needed to the CFO that talks every day with our people in the US. Why the US market cannot be left? For sure, it is a very, very important market for all the companies that want to have the ambition to work outside Europe, where the market, unfortunately, is reducing, is contracting. Let's remember that on the other side of the US, there are some importers that are facing some difficulties because they're aware that there are the tariffs, and the European customer, they charge the tariffs to the importers, and of course they have to charge these tariffs to the final customer, and sometimes they risk to lose the customer. Of course, leaving now the US market is it means that it's not possible to re-enter in the market in a short time, because it could be considered unreliable and not is very opportunistic. It is reasonable to accept a period of reduced margins and can be considered a future investment to hold the position in the US. But what we can say for sure that the companies that have consistently invested in the US all over the years, they have consolidated the margin, the revenues, and for sure that we have a lot of cases, business study case that we can say that in the years, US market has become the first market in the world for that company. Of course, this market, the approach of this market has to be a long-term approach. When we think this market, we have to plan and to focus for a minimum 5 to 50 years. It means that we companies they don't hope they don't. It's better to don't expect to make margins in the first years, in the first 2 or 3 years. But of course, there is a time when the company decides to build up their knowledge of the market, and this market companies that address this market has to see this market as a market where to stay for 50 years, not for a few years and then to leave. Why? Also because the biggest consulting company says that for sure in 2030 it will be the first market in the world, and the third in 50 years. So, and after China and India, because they have to grow for the population that they have. Europe and Japan are considered, unfortunately, markets that are affecting. They will experience as a decrease of the growth in the next decades. So thank you for following this webinar, and I hope it could be interesting for sure. You can send us any question that you have, or you can just send us a question or whatever, and we are happy to answer to your question at any time. Just email us or just call us on the phone. Come on.
Thank you all very much. Marco, can you go back to the slide with our contact email on it? I think it's slide 4 or 5, something like that, so that everybody's got our email in case you have any follow-up questions. Feel free to reach out. Thank you all for your time, and thank you also, Mauro. We will share with you the recording of this webinar for you to have, and have a wonderful rest of your day. Thank you all.
Thank you.